Good morning.
Morning,
Welcome
good
to the
morning.
Department Report for February 5th, 2026. I'll start by calling the roll. Joseph Borelli. Thomas Brown.
Good morning, Patricia, present.
Bill Dukes. Oh, I see that
Kevin.
Kevin is here. Kevin Lowe.
Present.
Gregory Faulkner. Amy Slattery.
Present.
Victoria Lee.
Good morning, present.
Christina McGrath. Good morning, present. We have a quorum. I'll hand it over to the chair.
Good morning, Patricia. Good morning, everybody. We'll start the agenda today with the December 2025 Passport Funds Flash Report. And I think Amanda is here to help us out.
Sure. Thank you, Tom.
How are you?
Doing well, thanks. And yourself? Here. All right. So closing out the year for the passport funds, we have December results for the end of December for the variable funds here. And the good news is it was a very strong year. So ended the year at 23.6 billion in total assets across the variable funds. That's up from 21.2 billion at the end of 2024. And a lot of that is attributable to very strong equity markets throughout the year. So for the month of December, I would say modest market appreciation in equity markets, primarily driven by non-US markets, while US markets were essentially flat for the month. We also did in December see an additional Fed rate cut, another 25 basis points on that key interest rate there, which has now been cut 175 basis points since the peak in 2024. So the diversified equity fund, you can see at the top of the slide there, which is where about 90% of the assets sit within the passport funds, was up about 75 basis points for the month of December. Most of that coming from your international equity fund. We also did see some outperformance from the active management sleeves within both US and non-US equities. Looking out to the 1 year column, very strong absolute returns at over 18% for the diversified equity, although trailing that custom benchmark in large part because the year on the whole has been a very challenging environment for active managers. So both your US and international active sleeves have trailed their respective benchmarks somewhat, and that's really been the case across the market. But overall, a very strong month to close out the year.
Thank you, Amanda. Any questions for Amanda? So we'll skip right 1 month ahead and then we go into January 2026, the preliminary benchmark performance. Amanda's going to take that as well.
So 1 second here. So we don't yet have our January results for the passport fund. So just sharing here benchmark results through the close of January. And again, another positive month in markets in most asset classes here across the month of January. Some of the positive things we saw, certainly again, continued strength in non-US markets. We also saw robust earnings for the most part, corporate earnings that have come in for the fourth quarter. But we also had some volatility driven primarily by some geopolitical events. So if you think about the US intervention in Venezuela, that raised some concerns about oil markets in particular, and then some of the political posturing around Greenland, both any of those events that caused some market uncertainty. But as we have seen over the last couple of years, we saw the markets rebound very quickly in both cases, right? So neither caused really dramatic market impact, and we ended the month here in positive territory. So again, international markets leading the month. You can see developed markets up around 5% for January, emerging markets up close to 9%, with US markets up around 2% for the month.
Thank you, Amanda. Any questions? Great. We move into the public agenda for the pension fund. We have a performance update by Dan. Is it at the table perhaps, or whatever you're comfortable? Whatever you prefer, really. Right there. Okay, great. Right there. Thank you. Well, appreciate it. Our pleasure.
Good morning, everyone. Pleasure to be with you again today. Why don't we jump right in? The slides you see, again, very familiar to you with the same content that we've seen over the last few months. I'm going to kind of highlight some issues and not gloss over, but move kind of quickly over the other ones, just not to belabor certain points that we've already made. Don, could move to the next slide. Thanks. So, just again, top right there, the real GDP. We're starting to see some December prints. You see China and Germany have posted up their quarterly observations. These, of course, are annualized, so it's a quarterly number that's been effectively multiplied by 4 to give you an apples-to-apples comparison across those economies. Our most recent observation was, again, from September at 4.4%. We expect results out from them on February 20th this year. And the expectations are, depending on who you look at, a bit higher. The Atlanta Fed GDP now suggests a 4.2% print for the fourth quarter. That's a bit higher than the New York Fed nowcast, another source. They're showing a 2.7% growth rate there, which has an interval of something between 1.6 and 4%. So their estimates tend to be a little bit lower. Obviously, we find out towards the end of this month where it actually comes. But what's driving a lot of that information actually is the net export number. That seems to be, at least in the Atlanta Fed's model, that seems to be causing most of the variability that you see in there. As we look at the unemployment numbers there, the jobs market showing some moderate improvements at the margins. When we last spoke, I showed you the unemployment rate at 4.6% for November. That number was subsequently revised down a tick to 4.5%. And then the December print came in at 4.4%. So it's good news, but nothing that's going to move markets or necessarily changes policy. Labor participation rate is also down 0.1% to 62.4. Not abnormally high, but again, we know that the prime age labor participation rate, workers age 25 to 64, is near its historical high. The non-farm job creation also remained positive. It was somewhat anemic compared to what we've seen in recent months. So we saw 50,000 new jobs there in December created, which is a little bit higher than it has. I'm sorry. Is that a little higher?
You said
A little bit lower than the census estimate of 70,000 jobs, and a little bit lower also than the 56,000 that we saw prior month. Monthly employment numbers are normally released on the first Friday, so it would be tomorrow of each month. We've got a partial government shutdown, of course, which seems to be pushing that number, that report out to next Wednesday, last I checked. When they are finally released, the economists are expecting no significant changes to the unemployment rate or the labor participation rate. So we're looking for another 4.4% unemployment rate and 62.4% labor participation rate. And then finally, with employment, I'll just note there were a few large layoff announcements. It's earnings season. About a third of the companies in the country have reported their earnings for the fourth quarter. And some of the things falling out of that, Amazon are expected to cut about 16,000 jobs globally in 2026. And then UPS came in with a 30,000 job announcement. So not great news on a forward-looking basis. Certainly some headwinds to the employment number. I look back a couple of years. These are some of the larger layoff announcements that we've seen over the last few years. Again, it's driven a lot by Amazon and UPS in particular are sort of retrenching and finding less labor-intensive means of delivering effectively. So UPS is scaling down because as a reaction to Amazon, they simply are delivering fewer packages in that agreement. Amazon's also reaching. Since we're there, look at the world currency rates. Again, no new news there. Just again, tailwinds. It is a story of a weaker dollar over the long term. No huge changes most recently. Nothing to really note, but again, good news for holders of non-U.S. investments and implications obviously to the macro side. But I'll get into it a little bit later on the next slide. But there was a bit of a pop in the U.S. dollar last week, just with the announcement. There was a bit of the U.S. dollar recently rallied a bit last week, just after the announcement of the Fed governor. And then Donald, if we could just move left again. Sure, right. Our inflation there. So inflation estimates again have us mid-pack among our peers. The December numbers came in at 2.7%, which is what we were expecting them to be. Still a bit higher than the target, but again, not significantly. So why don't we move to the next slide? So again, top left there are surveying the official rates of the U.S. and a few other major central banks. The Fed met last week, 27th and the 28th, and as expected, there were no rate changes. Amanda mentioned that we're at 3.75% target rate, down from 5.5, so 175 basis point reduction. It's quite likely that those will remain there for the foreseeable future. The real news of the day is that the president nominated Kevin Warsh to be the next Fed chair. He's seen largely as a very serious candidate. Got some stats here on him. He was a former Fed governor, youngest in history as it happened, where he acted as Fed's liaison to Wall Street, and he had a front row seat through the GFC. So understands market turmoil and gained clearly some experience there. He's a policy advisor and was the executive secretary of the White House National Economic Council under George W. Bush. More recently, he's been in academia. He's a distinguished visiting fellow in economics at Stanford's Hoover Institution, and he was also a lecturer at Stanford Graduate School. So again, deep economics, deep macro experience. Historically, he's been seen as hawkish on inflation and monetary policy, so kind of a conservative voice in that space. But more recently, to be fair, even before this administration, his commentary has been more aligned with the president's vision. So lower rates, higher growth, in this environment. So that leaves an open question as to which direction he'll follow if he's confirmed. I think the balance of the commentary seems to be that the Fed gets to maintain its independence. It won't be as subject to political winds as some people had feared. So that's a good news. As we think about confirmation, or his confirmation, the objections I found in the news really didn't center on his qualifications. It was more political motivations. There's a group of senators that, for instance, want a law. There's a criminal investigation into Chairman Powell right now over whatever they do, political investigations or investigations for it. They'd like that dropped before confirming, Secretary Warsh. And, so it's again, political considerations that will cause any roadblocks to his confirmation rather than his qualifications in that spot. Markets reacted well to the announcement. The dollar rallied as the certainty around who was going to be appointed lifted. And then you also saw, you may have seen in the news, kind of a rapid and significant sell-off in both gold and silver. This was late last week. And again, all driven by the dollar strengthening. So people were going out of these kind of safe harbor assets back into the dollar.
Dan, if I may, I think one of the big economic stories of 2026 is going to be right around this topic. And that is, it feels like we might be in an inflection point with the relationship between the Fed and the rest of government. And as you well know, the independence of the Fed is under a lot of stress. To put a cap on what Dan said, we don't know which Kevin Warsh is going to show up. Is it going to be the inflation fighter of a few years ago during COVID, or the inflation reducer responding to the president's concerns? But given the numerous challenges that that the White House has made to the Fed, it'll be, I think, a historic year either way. Either the Fed will hold its ground and maintain its independence, or it will become increasingly subject to the whims of the president. And too soon to see how that'll play out. And it's impossible to say what the markets will think about that, because there's just too many threads. The Fed is just at the center of the global economy in a way that we shouldn't underestimate it. A change in regime there, and I don't mean the people, but rather a change in the role that the Fed plays and how it does its business could have profound long-term impacts on the economy. I'll leave it at that.
Thanks, Monty. Well said. That was a pretty eloquent bow on it, actually. As you look down toward the bottom there, again, this is the same yield chart. Just reiterating, the yield curve today, that red curve, it's good news in a couple of respects. First, we're receiving carry on fixed income investments. You're getting compensated for investing in treasuries right now in a way that you weren't 5 years ago. And then you'll note that that positive slope of the curve is generally considered to be healthy, right? It indicates proper functioning of financial markets. You have term premiums, so you're getting, right, it's kind of how banks work, right? They borrow in the short term, lend for the long term, picking up a positive spread. So this is good news for that. Our 2-10 spread, if you want to move over to the right a little bit, is at 61 basis points. Do I have that right? Yep. Again, anything between 50 and 100 basis points is considered good news. And then just kind of wrapping it up, the corporate spreads on the back, again, that's the amount that you're compensated for investing in investment grade or high yield corporate debt, respectively. Again, near their all-time lows. Again, it's suggestive of free-flowing capital and market, positive market sentiment. And then down the bottom, the 30-year mortgage at 6.25. Again, down about 1% or 80 basis points from a year ago. About 1% to go before we hit about its long-term historical averages, but moving in the right direction, certainly. And then gold, we've kind of already spoken about, where you had a huge premium over what we saw last year, just an indicator of uncertainty in the marketplace. So I'll leave it at that. I'm happy to take any questions you might have.
Any questions for Dan? So you combined, and that was your market commentary as well.
That was, yeah.
You combined the two of them. Great. Any questions for Dan? Thank you. So that brings us to the end of our public agenda. Does anyone have anything to add or something while we're still in public? Great. So I'll entertain a motion.
Someone?
Great. Okay, then. Second, and it's been second. Any questions, comments? All those in favor of moving into executive session, please say aye. Aye. Always say nay. Abstentions? But we're in executive session. We are back into public session, and we're going to have a readout from our own Priscilla Bailey. Thanks. Hey, Priscilla.
Hello, Mr. Chair. How's everyone?
Good. How are you?
Very good. In the executive session of the Passport Fund, there was a manager update. In the executive session of the Pension Fund, there's an update on preliminary performance, which was followed with a presentation on alternative credit. Consensus was reached on the alternative credit presentation. Details to be made available at the appropriate time. Thank you.
Thanks, Priscilla. That brings us to the end of our public agenda. Any questions or comments? Great. And as always, we thank Will, our reporter, and David, our TRS tech person. Of course, as always, behind the scenes, Liz Sanchez. So do I hear a motion to adjourn?
So moved.
It's been moved. Do I hear a second? It's second. Any questions, comments? All those in favor of adjournment, please say aye. Aye. Opposed, say nay. Thank you, everyone. Adjourn.